Hi, hello, namaste, sat sri akal. This is Kunal Bothra, and we are back again with one of a very thrilling topic for all of you guys: the good, the great, the ugly. This is a video which we've described the recent trends on the Nifty 50, and we've broken it into pure technical structures for the index. Uh, if you've known me, then over the last many years, we've been tracking the Indian markets as well as the global markets. And the most recent calls which we've given, and some of the turning points actually which we flagged off, something for example in June, mid of June 2022, where we flagged off that the market breadths was extremely oversold, and then we initiated a major buy on the index that was around the 15,200 odd levels for the Nifty, where we signaled off that the market breadth is at a one of a kind low, and that these are points where the markets may not stay significantly for a significant amount of period, and we expected a major recovery to pan out, and that's what happened for the index. The rest is history. The recent one was on 20th of September 2022. That was a time when we came out all guns blazing, saying that the markets, or specifically the dollar index, would top out at 114 to 115 mark, and over the series of the next 1 to 3 months we could be seeing a sharp correction, and that's what exactly happened for the dollar index. But that was past. Today, what I'm trying to bring to you is something which is one of the best analysis which we've done. I can assure you that by the end of the video, you would be thrilled to watch that such kind of analytical work which we have done, which would leave you completely amazed on the three different aspects. So what we've done is we've broken the view on the index into three different aspects. The very immediate term, like for the next maybe few trading sessions, something which is a bit near term, and the third part, which is the so-called ugly part, is something which will help us decipher the trends for the remainder of 2023. Trust me, at the end of the video, I would believe that you would be left amazed with the kind of data work which we've done. But before we begin, I would request everyone to please subscribe to the video, hit to the bell notification, the notification bell, and don't forget to like, share, and most importantly, leave a comment if you've liked the video. So let's get going. Without much ado, the three different aspects: the good, the great, and the ugly on Nifty 50. So this is where we are. We would now showcase the three important portions of where we expect the markets are heading towards. Now, the first part is the good part, which is on the Banknifty technical charts. Now, what has actually panned out, why the structure of Banknifty is very important and very critical to watch out for. The first aspect which you can see on the charts is the triple divergence in Banknifty. So what we are seeing right now is triple divergence. Now, I'm sure all of you guys who actually follow technical analysis knows that triple divergence is a very interesting concept in stock prices as well as asset prices, where it gives an indication that the markets or the asset class are getting into a phase where its direction is completely different than the direction which is portrayed by the indicators. Now, triple divergence has a very good strike rate historically, and it generally signals that the index is getting into a phase of a bottom out. Now, depending on where the triple divergence is spotted on the charts, whether it's on an intraday basis, whether it's on the daily charts, the weekly charts, the magnitude of the recovery could be scaled up depending on where we spot the triple divergence on indices or on the different asset classes. Now, for example, over here, we've spotted a triple divergence on the Bank Nifty. This is the data for the last 2-3 months from where the Bank Nifty started to get into a corrective phase. So as you can see that the Bank Nifty started to get into a correction from 44,000 levels to where we recently made a low, which is around the 39,600, 700 mark on the Bank Nifty. Almost three successive lows. So what we've covered is we've covered the closing lows for the Bank Nifty, because that's how the RSIs are generally calculated. And we've then mapped it with the lower grid of the indicator. So as you can see, I've marked with three different circles: the yellow, the green, as well as the blue. When the prices for Bank Nifty hit three consecutive lows for itself, look at the resultant effect on the RSI. The RSI apparently made a very similar kind of a low. So it's a sort of a divergence which indicates that the indicator is not relenting to go down. The indicator is actually starting to be very robust over here. Now, why is this significant? This is significant because just the very recent charts for Bank Nifty, the very recent example for Bank Nifty was when the Bank Nifty made such a similar, I would say similar kind of a three successive lows on the prices, and the RSI divergence was again very, very similar. This was March to June 2022. This is exactly the point which I flagged off, that we came out with a contra buy on the index, on the Nifty specifically, that the Nifty is forming a major divergence over here, and we could be at a cusp of a major bottom. Now, the same data could be panned out in Bank Nifty, where the Bank Nifty forms almost three consecutive lows for itself. But the indicator, that's the relative strength index. I'm sure all of you guys know the importance and the relevance of relative strength index, the RSI, and the significance of RSI specifically at critical lows or major lows for the prices. So as you can see, again, the yellow circles, the green circles, as well as the blue circles indicate three successive lows in prices relatively, and three higher bottoms on the indicator, that's the RSI. Now, after that third divergence is spotted is where we expect the markets to get into a bottom formation process. And as we've seen, post that, the Bank Nifty got into a huge rally for itself. So this was something which has happened in June 2022. I'm not saying a similar magnitude of a rally could probably pan out, but then triple divergence indicates that maybe, just maybe, over the near term, the markets could get into a settling phase, that at least the near term bottom could be at play. Now, can just triple divergence be a good enough evidence to justify that whether the markets have bottomed out? We've looked at the other aspect, that is the very, very short term charts, the last 4 days of candle charts. So after 5 days of consecutive selling for Bank Nifty, as you can see, the Bank Nifty is forming a 4 structure pattern. So I've marked it with candle number 1, 2, 3, and 4. Now we'll start off with candle number 1. So as you can see that the candle number 1 is indicative of a bullish hammer or a bullish doji kind of a pattern for itself. This is the first sign or a first indication that a near-term bottom, which was around the 39,500 mark, which also coincided approximately with the budget day lows, budget 2023 lows for the banking index. So the Bank Nifty hit that low of approximately 39,500 levels, and then we bounced off. We closed flattish to give candle number 1, which in effect formed a near-term bottom for the banking index. Then comes the candle number 2. So as you can see that the candle number 2 is also very intriguing, because even though it's showing a red negative candle, it's showing a bearish kind of a candle, but you've seen the incremental sell-off. By incremental sell-off, I mean compared to the closing of candle number 1, the closing of candle number 2 is relatively mild to negative. Because the previous 5 days, the prices were going into a very sharp correction. And as generally we say that when the prices go into a sharp corrective phase, the last phase of correction is very intense. But surprisingly, in the candle number 2, the relative or the incremental correction is not there for the bank index, which means that the strength of the bears was getting a bit weaker, as we can see in the candle number 2. Now, the third candle is something which is extremely encouraging. This is classical bullish divergence. So as you can see that candle number 2 was engulfed completely by candle number 3, which is what we call as a classic bullish engulfing pattern. This indicates the dominance or a possible dominance of bulls making a strong comeback. So as you can see, candle number 3, the markets actually opened on a negative note. Okay, the Bank Nifty on this day opened on a negative note, but then we not just covered up the negativity, but we managed to absorb the pessimism or the negative price data for the last 2 candles on that third candlestick day for the Bank Nifty. So that indicates that it was not just a recovery of sorts for Bank Nifty, but it was a recovery which managed to engulf 2 previous consecutive days of price action. And that is something which is very, very encouraging. Then comes point number 4. Now, we say that for every bottom to be formed or to be tested, the bank nifty or the asset class has to retest and test the strength of the new party, which is in this case the bulls making a comeback. So candle number 4, as I've shown in the subset as well, that the candle number 4, the bears are trying to penetrate the lines of bulls. So generally we say that अगर 50% के नीचे जो 50% of candle number 3 के नीचे अगर जाता है, then it is a pullback where the bears still hold significance. But if we don't correct below the 50% line, and if we make a comeback prior to that, that tells you that the tide is changing and the sides are changing. So this time around, the candle number 4, which I even tweeted on my Twitter handle, that the bank nifty is now getting into a zone where the bulls are getting stronger and the bears are getting weaker. So this is the good part about the markets. I hope you agree. So the other good part about the Nifty is the Nifty50 and the overall market breadth. So one of the indicators which we worked upon extensively over the last decade and a half and which have given extremely strong results to us has been the cumulative market breadth. We call it the CMB indicator. Now, over the last many tweets as well on my Twitter handle, that's KB Bothra. We've tweeted a lot on the CMB, that how the CMB indicator, when it gets below a zone of -10, which you can see on the chart in front of you, that the zones which you've marked with red circles is where the CMB indicator, that's the bar chart at the lower grid, when it goes below -10, that's where the resultant effect is that the Nifty gets into a bottom formation process. Now, of course, the bottoms which we're talking of over here are more of a short-term oriented bottom, which provides a bounce of somewhere around 2% to 3% on an average. Again, this depends on the intensity and how much time the index has spent at the -10 levels. The CMB indicator has spent below the -10 level. So in this case, it's just been, I think 2 or 3 trading sessions that the CMB indicator is below the -10. There have been periods where the CMB indicator remains below -10 for a period of weeks at a trot. And then the revival which we expect on the index is much more lasting. So as I said, it all depends on how much time. As of now, it's just been the 3rd day where the CMB indicator, that's the cumulative market breadth indicator, is trading at a level of which is below -10. Now, this could probably be an indication that even the Nifty is getting into a bit of a tiring zone on the correction, and we may expect a decent bounce for the index over the near term. So 2 data points which we've covered. One on the Banknifty chart showing the triple divergence on the Banknifty, as well as the very recent candlestick formations. And the second and the most important one, which is a bit of a different angle from the Nifty perspective and the Nifty in the overall market breadth, that's the CMB indicator. The great part. So the good part, of course, is on pure technical aspect, but the great part, and I'm sure you must have tracked this data point as well, or you must have come across this data point. But the interesting reading about this data point is the exciting part as well as the terrifying part. So the same data point can be read as well as broken into 2 different sets. So are you ready for the 4th, the most dramatic data point, which you can see on the indices? The Nifty has not seen 4 consecutive months of closing in negative in the last 2 decades. Yes, you heard me right. In the last 20 years, the Nifty has not seen 4 successive months of closing in negative. Now, in the last 20 years, I would say different kind of crises have been thrown to the markets. We were thrown, a level of 2008. We've seen the GFC in 2008. We've seen the COVID correction in 2020 as well. There was an intermittent correction in the year 2015, 2016 as well. And there were many short-term corrections in between as well. But in those, even in those years, terrible years or terrifying years for the markets, we've not seen 4 successive months of closing in the negative. Okay, so this forms the great point about the markets. We'll go deep into this point, and I've looked at the data for the last, for the data panned out for the Nifty 50, and as you can see, from 2002 onwards till 2023 so far, where we are right now, we've not seen 4 consecutive months of price closing on the negative side for the Nifty 50. This brings us to one very important set of data points. The first is on an average. So if you see on an average, on majority of the years, we've seen approximately 5 months to be months of negative returns. Now, for example, in years where there is a lot of negativity, pessimism in the markets, the number of months there have been 9 months which have been negative for the markets. And in great bull market years, like years where the markets are going into a completely strong uptrend, there's been a minimum of just 1 month which is negative throughout the entire calendar year. But again, on an average, approximately 5 months on an average comes out to be negative. Okay, right now we've just completed 2 months of negative returns on the Nifty 50. More importantly, last time, December, Jan, Feb, the combination which was negative was seen in COVID. So December 2019 was not exactly negative, but then it was a selling from the top, which was seen in December 19. Jan 20 as well as Feb 20 was but 2 months where the markets have corrected. Now, these two data points throw a very important picture, which also brings us to the ugly part of the market. And this, I believe, is one of the best analysis which we've done, culling out the data from the last, not just the last 20 years, but we've gone beyond that as well. We've gone pre-2002 to try and tell you what happens in cases of exceptions. So we've discussed that in the last 20 years, there have been just 3 data points, or rather 3 consecutive months where the Nifty is closed negative. The 4th month is generally where we expect a bounce. We expect a recovery. We expect a rally. We expect a positive closing for the index. But what happens when the 4th month, or is there a data which tells us that even the 5th month is actually negative for the index? So this brings us to the very, very important aspect of this video today, the ugly part of the market. What if March 2023 and if April 2023 goes into negative returns for the index? What could happen in that scenario? And whether there have been historical data points which tells us what happens in cases when the correction extends from 3 months, goes into the 4th as well as the 5th month as well. And I'm sure that you are going to love this data point and the analysis. So there have been 3 occasions where the Nifty 50 has given 4 to 5 consecutive months of correction. One was in 1996, the year 1996. We'll flash off the period in which exact months of 1996 that the Nifty gave 4 successive months of correction. 1998 as well as 2001. Yes, there have been 3 years where the index has gone down 4 months to 5 months as well on a negative closing month on month basis consecutively. Now, there is a very, very interesting aspect about these 3 years, and something which I believe should probably stun you as well. So are you ready? 1996, the correction started off from the month of July. Is actually the month of June 1996 is where the index has given positive returns. The month of July is where the correction started off. So July, August, September, October, and November, 5 straight consecutive months where the Nifty gave negative returns month on month. Okay, compared to the previous month closing, of course. So 5 consecutive months where the Nifty gave negative closing. Do you know what happened in that 5 months of correction? How much did the Nifty correct? The data point is in front of you. The Nifty from the month of June highs, which was around 1200 levels, corrected to as much as 775 by the end of 5th month, which means a correction of a staggering 35% on the Nifty. This was in the year 1996. Let's move ahead. The year 1998. So we started off April 1998 as the green month, and post that May, the adage which goes sell in May and go away. May 1998, June, July, August 1998. 4 consecutive months of negative closing on the Nifty. Can you tell me how much did the Nifty correct in these 4 months? So from the April highs, 1998, the Nifty corrected from 1203 to almost as much as 830, which means a correction of more than 32%, which was seen in 1998. And the last data point, which is again a very terrifying data point, the month of the year of 2001, month of May 2001 apparently was green. June, July, August, September. 4 consecutive months of price selling, and the correction in the year, so as I said, in the year 1998, it was from 1207 to 850, and the correction in the year 2000 was 2001 was from 1203 to almost as much as 850, which means a correction of approximately 30%. So this brings us to a very, very important conclusion as well as a point, that average selling of 4th month and the 5th month in some cases is more than the average selling of the first 3 months. We've broadly seen that the average correction of 4 months or 5 months as a cumulative bunch is approximately 25 to 30% in many cases. 25 to 30% in many cases is where we expect, where we've seen historical corrections. Now, what could happen if the Nifty starts off getting into that similar kind of a corrective phase? Imagine what could happen to the index this time around. So do you know the recent top? The recent top for the Nifty was at 18,888 levels. And if you try and do the math for the index from 18,888, so far we are just at 17,300 odd levels. I think that's what the recent correction has shown to us. So if you do the math from 18,888, if you deduct 25 to 30%, the ugly part of the markets would probably take the Nifty towards 14,200 to 13,200 levels. So yes, the ugly part of this correction could probably take the index in the next 1 to 2 months towards that kind of a level as well. I'm not saying that this is the most likelihood scenario, but I'm presenting to you a data which has worked fabulously well in just the 3 occasions since the start of Nifty50 as an index, and it has worked exceptionally well in those three occasions. Luckily and fortunately, I would say that we've not had more than 3 consecutive corrections or negative closing for the month on the Nifty50. So we can just hope, we can expect that the month of March is not negative in closing, because if that's the case, then it could be a very, very, very tough month of March, as well as probably the month of April. So far, for example, in the month of December, Jan and Feb, I think the average correction for the Nifty is 2.75% broadly, which means we've corrected from 18,888 approximately on the spot Nifty to 17,300 mark. But the good part about the markets, about this particular view, is that if in case the market gets into a sell-off mode, if in case we see the fourth month and the fifth month to be consecutive negative for the Nifty, this brings in a point that historically, and the three occasions when this has happened, that's the year 1996, 1998, as well as 2001, the 3 years when the index has given more than rather 4 months or more than 4 months of successive consecutive month-on-month negative closing on the Nifty 50, those lows or the lows which were formed in those months were not tested for years to come by. So, for example, in the month of in the year 1996, when the index made a low, I think the low which was made in the month 1996 was around 775, as we indicated. That was never tested post that month of post the year of 1996. In the year 1998, when the markets made a low, so as we indicated, the low was around 800 odd levels for the Nifty. We did not break below that 800 mark for the next many years to come by. Even in 2001, when the Nifty gave 4 successive months of negative closing, the low which was hit was around 850, 849.95 to be precise, and we did not make a low which was below that 850 mark henceforth on the Nifty 50. So this tells us the ugly part of the market, that if in case this correction extends to the next third and fourth month, it's time to buckle up your seat belt. It's time to buckle up and be ready for what could be a terrible correction for the markets. But the shining part or the positive aspect is that this could probably bring us finally or culminate this correction or this impending correction on the Nifty 50. So this also gels with one of the observations which I have tweeted recently, as well as an observation which you've been following since 2013 to 14, is where we started to flag off that the markets are getting into this strong Banner cycle mode. So this Banner cycle also indicates that 2023 is a year where the markets may form a significant bottom, a bottom which could not be tested, which may not be tested for the next many years of a foreseeable and a highly probable bull market. So for that, you stay tuned and watch our next video, which we will present to you on Banner cycle, a cycle which has worked exceptionally well, at least in the global markets, and which has a history of not just the last 10, 20, 25, 30 years, but has a history of more than a century, of more than 100 years of data, which indicates major cusps of low and major cusps of highs, as well as scenarios of panic and euphoria in the economies as well as in the markets. So that's what we will present in our next video on the Banner cycle. I hope you've liked this observation on the Nifty 50 and the good, the great, and the ugly. Now, let's hope that we just get the good and the great part which gets played out and not the ugly part. But in case if the ugly plays out as we anticipate, then the data, the historical data on the Nifty 50 indicates that this could be a year where dramatic lows can be made on the indices, and we could be possibility at a cusp of a major low being formed in this year. So with that hope, that positive expectation, I'm signing off. Thank you so much. Don't forget to like, to share, and don't forget to leave your comment on the video. Do subscribe to the channel as well as hit the notification button as well. Thank you so much, guys.